Bitcoin is one of the best performing assets this century, and it's basically been going up only over the last decade. However, as Bitcoin has grown, so too have the stakes. A build-up in leverage, a concentration of holdings among a few entities, and the threat of a quantum attack are just a few of the risks that could derail this historic rally. And that's why today we're going to take a look at some of these top risks to Bitcoin, how likely they are to occur, and how they could impact the price if they did. My name is Nick, and if you hold Bitcoin, this is a video you can't afford to miss. The first risk to Bitcoin is a timeless classic, and that's a build-up in Bitcoin-related leverage. And this is something that we've seen in almost every crypto cycle, and it looks like it's a bigger threat this time than ever before. Now, for context, it's common for Bitcoin holders to use their Bitcoin as collateral to borrow during bull markets. Historically speaking, this borrowing was mostly limited to institutional investors. However, since 2021, Bitcoin-backed loans have become increasingly common both in centralized finance, aka CeFi, and decentralized finance, aka DeFi. And here are a few headlines about it that you may have missed. In January this year, Coinbase announced it was rolling out USDC loans backed by Bitcoin. In March this year, Xapo Bank announced it would be launching Bitcoin-backed loans as well. Just last month, Strike announced it would also launch Bitcoin-collateralized loans, with CEO Jack Mallers bragging in an interview that they could give loans of up to $1 billion. And just a couple of weeks ago, Cantor Fitzgerald announced that it had launched its Bitcoin loan service with a limit of up to $2 billion to start. As a cherry on top, a report from Galaxy Digital found that Tether accounted for nearly 3/4 of the CeFi lending market. Given Tether's connections to Strike and Cantor Fitzgerald, it's possible that it's intertwined with the lending programs that they're offering. And that's just on the CeFi front. On the DeFi front, over 166,000 Bitcoin are currently being used in DeFi protocols, mostly as collateral for borrowing. And this is thanks to the recent launch of more accessible forms of wrapped Bitcoin, like Coinbase's BTC. And this has resulted in an explosion in DeFi lending using Bitcoin as collateral. As we highlighted in our video about wrapped Bitcoin earlier this year, this leverage is likely to be rocket fuel for the crypto market on the way up, including for altcoins. Consider that a lot of these stablecoins being borrowed against Bitcoin in DeFi are likely to flow into other cryptos on that altcoin blockchain. As we highlighted in that video, however, this leverage could be dynamite on the way down as well. And history suggests it's a question of when, not if, that dynamite's fuse will be lit. All it would take is some exogenous shock that results in Bitcoin crashing around the margins, and liquidations will begin. This time around, though, the risk is more likely to be found among retail borrowers than institutional borrowers. For example, there could be many retail investors who use their Bitcoin as collateral for loans thanks to its accessibility. Something happens and all that collateral gets sold, pushing Bitcoin's price down very quickly. And this could trigger liquidations among larger Bitcoin-backed loans that were taken on by institutions, resulting in a wave of selling pressure that takes Bitcoin much lower than investors expect. There's honestly no telling how low Bitcoin could go because analysis tends to break down when there's forced selling. Never mind the fact that it's impossible to know just how much Bitcoin leverage is being taken in CeFi. What is known, however, is that only 34% of you are subscribed to the channel. So if you're enjoying this video, why don't you liquidate that like button? Don't forget to subscribe and ping that notification bell as well to ensure that your crypto content is fully collateralized. Back to the video. Now, all this leverage ties into the second risk to Bitcoin, and that's concentration risk. Believe it or not, but this risk could come from DeFi rather than CeFi. Now, for reference, we believe it's possible that as much as 1 billion Bitcoin could be wrapped by the end of this cycle. Now, imagine that there was a huge major DeFi hack or exploit. This could theoretically result in billions of dollars of Bitcoin being stolen and sold, potentially causing liquidation in DeFi protocols in the process. Fortunately, this may not be that big of a risk in terms of price impact, just because most of the wrapped Bitcoin that exists is centralized and can easily be frozen. Unfortunately, the concentration risks in CeFi are exponentially bigger risks in terms of price impact. And if you've been keeping up with this channel, then you might recall a video we did with Arthur Hayes and Raoul Powell last year. In that video, Arthur warned that the biggest risk to Bitcoin could be a hack of an inexperienced crypto custodian, like a bank, for example. And recent changes to bank regulation make this risk a very real one. But of course, the big name when it comes to concentration risk is Strategy and other so-called Bitcoin treasury companies that have been selling shares and issuing debt to accumulate Bitcoin. As some of you may no doubt have heard, Strategy warned in an April 2025 filing with the SEC that it could be forced to sell its Bitcoin under some circumstances, like paying down existing debts and other financial obligations. Specifically, the filing said, quote, "A significant decrease in the market value of our Bitcoin holdings could adversely affect our ability to satisfy our financial obligations." And, quote, "If we were unable to secure equity or debt financing in a timely manner on favorable terms or at all, we may be required to sell Bitcoin to satisfy our financial obligations, and we may be required to make such sales." Thankfully, this does not seem to be a risk for Strategy, as it has survived one crypto bear market already and can presumably survive the next one. However, the same cannot be said for the other Bitcoin treasury companies, and they could be the reason that Strategy is forced to sell during this next downturn. Many key players in crypto, including Bitcoin bull Max Kaiser and digital currency group CEO Barry Silbert, have mentioned this as a risk to Bitcoin in interviews, and it makes sense. Issuing debt to buy Bitcoin is a form of leverage that could backfire during a broader market drawdown, just like borrowing against Bitcoin. And if you watched our video about Bitcoin's supply crunch, you'll know that public and private companies hold over 1 million Bitcoin between them. Although it's unlikely that all of these companies would be forced to sell Bitcoin during a downturn, if even just a few of them did, it could do serious damage to Bitcoin's price. At the same time, it could trigger a wave of liquidations in CeFi and DeFi as collateral value begins to fall. And this relates to the third risk to Bitcoin, and that's politicization. In case you missed the news, Trump Media recently raised almost $2.5 billion to buy Bitcoin for its own Bitcoin treasury. Trump also launched a meme coin, an NFT collection, a stablecoin, and will soon launch a DeFi protocol too. In other words, it looks like Trump is involved in literally every aspect of crypto. While a lot of scrutiny has been around Trump's meme coin, the recent Bitcoin treasury could put Bitcoin in the crosshairs. For instance, many politicians and regulators could start pushing back against the US government's planned Bitcoin reserve on the grounds that it directly benefits Trump and his family. As you might recall, Trump signed an executive order establishing a strategic Bitcoin reserve back in March. And this executive order not only called for the US government to figure out how much Bitcoin it has and hold it as a reserve, but also to find ways to accumulate more Bitcoin without spending extra money. And some would argue that Trump Media's recent purchase of Bitcoin makes this even less likely than before. On that note, the Trump administration's push to make the US a pro-crypto country with Bitcoin as the focus could backfire internationally as well. You might remember that Germany dumped its Bitcoin on the open market last summer, and some argued that its decision to do this instead of sell OTC was an intentional move to damage Bitcoin, but it could also just have been pure incompetence. In any case, the point is that the possibility of another country dumping its Bitcoin as a retaliation against Trump's foreign policies was already high with Trump's pro-Bitcoin domestic policies, and it could be even higher now that Trump Media holds billions in Bitcoin. The elephant in the room is, of course, China. China is estimated to hold around 200,000 Bitcoin, worth over $20 billion. Not sure if you've heard, but the US and China aren't on the best of terms right now, and the trade war is just the tip of the iceberg. The Trump administration recently revoked the visas of Chinese students studying in the United States and is reportedly considering delisting Chinese stocks, among many other things. It's possible that one of the ways that China retaliates is by dumping its Bitcoin on the open market, just like Germany did last summer. And FYI, Germany sold around 50,000 BTC, and this was one of the many reasons why it fell by 30% last summer. Now, Imagine 4 times as much Bitcoin being sold on the open market, potentially with the explicit intention of doing as much damage as possible. Recall how that could trigger liquidations? From our perspective, the likelihood of this happening ultimately depends on how Trump's foreign policy evolves in the coming months. As we've seen, this is something that's fundamentally unpredictable. But if you insist on trading this market chaos, then check out the Coin Bureau Deals page down in the description or with this QR code right over here. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cashbacks on deposits of up to 75% on the best crypto exchanges around. These deals won't be around for long, so take advantage of them ASAP using the link down below. Now, the fourth risk to Bitcoin follows from the third, and that's the concentration of Bitcoin mining. Once upon a time, Trump said that he wanted all remaining Bitcoin to be mined in the US. Well, if the current trends continue, he might just get his wish, because US Bitcoin miners are gaining dominance fast. Publicly traded Bitcoin miners accounted for almost 30% of the hash rate late last year, and chances are that this figure is close to a third now. Now, for those unfamiliar, if an entity were to control more than 50% of Bitcoin's hash rate, then it could theoretically manipulate the blockchain along with Bitcoin transactions. Before you roll your eyes, consider that the Biden administration was working to create a registry of all Bitcoin mining operations in the US. Logically, if the US government knows where all the Bitcoin miners in the US are, then they could theoretically coerce them to do whatever it wants. As a not-so-fun fact, BlackRock could do something similar given its stake in these publicly traded Bitcoin mining companies. Combine BlackRock's stake in public Bitcoin mining companies with the fact that its ETF terms give it the power to decide which Bitcoin fork to follow, and you have what looks like a recipe for a Bitcoin takeover. Never mind that asset managers were also looking into who the most influential Bitcoin developers were. Regardless, there's a less theoretical risk related to Bitcoin mining concentration that everyone seems to have forgotten about, and that's the reliance on Chinese-made ASIC mining machines. And some of you may have seen the headlines about Bitcoin miners being unable to get hold of Bitmain ASICs due to Trump's tariffs. If the trade war with China continues to escalate, we could in fact end up with a scenario where Bitcoin mining companies in the US are unable to expand their operations. The good news is that this would reduce the risk of a hash rate concentration among US-based Bitcoin miners. The bad news is that many of these Bitcoin mining companies have engaged in their own Bitcoin treasury strategies. It stands to reason that a disruption to the supply of ASICs because of tariffs or whatever else would make it harder for them to raise capital or borrow money. And the result could be the exact same thing as what would happen to Strategy, Bitcoin mining companies being forced to sell Bitcoin. Speaking of which, this possibility, although painful for Bitcoin in the short term, could be beneficial for Bitcoin in the long term. And that's because if current trends continue, publicly traded Bitcoin mining companies will continue to account for more and more of the total hash rate. And this is due to the factor I just mentioned, their ability to raise capital and borrow money compared to other mining operations. The fifth risk to Bitcoin presents a similarly existential threat. And that's the possibility of a quantum computer cracking its encryption. In theory, it will be years, if not decades, before a quantum computer is able to do this. In practice, quantum computing has been evolving at an exponential rate. Not only that, but it's easy to forget that the cutting-edge technology we read about on the news is often months or years behind what's being worked on behind the scenes by governments and corporations. Obviously, the bigger that Bitcoin becomes, the greater the incentive for institutions who are threatened by Bitcoin to do something like quantum attack it to slow it down, be they governments or big banks. As with the concentration of hash rate among Bitcoin mining companies, the threat of a quantum attack against Bitcoin looks like a question of when, not if, assuming current trends do continue. And if you watched our video about quantum computing and Bitcoin, you'll know there's a large amount of old Bitcoin sitting in wallets that could theoretically be stolen by a quantum computer, most of which is already lost. And if you've been keeping up with the headlines about quantum computing and Bitcoin, you'll know that the Bitcoin community is slowly coming to the realization that some kind of a hard fork to delete or freeze this old or lost Bitcoin will be required at some point. It goes without saying that this could set a very dangerous precedent that could potentially open the door to adjusting Bitcoin's maximum supply of 21 million. If this were to happen, it would essentially destroy the narrative that Bitcoin is a digital gold, and it's possible that even just freezing the Bitcoin that's vulnerable to a quantum attack would shake investor confidence. Again, it appears to be a question of when, not if, this will need to be done. For what it's worth, it probably won't happen for the foreseeable future, and it could even be a buying opportunity when it does happen. Now, the final risk to Bitcoin to keep in mind is the macro, which includes everything from geopolitics to interest rates. As we've seen, any kind of uncertainty around things like tariffs tends to be a huge headwind for Bitcoin, while any hint that emergency stimulus could be the result of these tariffs causes Bitcoin to pump. Put simply, sometimes Bitcoin trades as a risk asset, and sometimes it trades as a safe haven. As far as we can tell, the biggest risk to Bitcoin on the macro front is that it fails to establish itself as a safe haven and keeps trading as a risk asset, particularly a higher risk, higher reward bet on US tech stocks. And this is because risk assets are likely to experience lots of macro headwinds in the coming years, particularly US tech stocks. For starters, the emergence of a multipolar world is likely to result in even more uncertainty around things like trade and geopolitics, which will be a headwind to risk assets. Meanwhile, it looks like investors from around the world are slowly starting to divest from US assets because of its domestic policies. Some macro analysts, like Russell Napier, for example, have gone as far as to argue that foreign investors like pension funds will be forced to divest from US assets to purchase the government bonds of their respective countries to suppress interest rates without printing money. Since the largest components of major stock indices like the S&P 500 are tech stocks, they will experience the most selling pressure. And if Bitcoin is seen by most investors as being a higher beta bet on US tech stocks, then Bitcoin could be sold off as part of this process. And this is more likely than you think when you realize that many of these tech companies, like Tesla for example, also hold Bitcoin on their balance sheets. Conversely, if Bitcoin manages to become a safe haven in the eyes of most investors, then BTC could very well continue its up-only trajectory, and all those macro headwinds could become tailwinds. And that's simply because Bitcoin is the only digital asset that can be self-custodied and have zero counterparty risk. This might not be much of a selling point right now, but it will be as the world becomes more fragmented and trust and cooperation between countries continues to decline. They will need a credibly neutral digital currency, and with a bit of luck, Bitcoin will become big enough for it to play that role. Notably, this could create some interesting incentives around Bitcoin mining, with countries potentially starting to run Bitcoin nodes and mine Bitcoin to ensure Bitcoin remains credibly neutral, and to gain more Bitcoin that they could then use to trade or whatever else. And you can learn more about that by watching our video right over here. And if you're not subscribed to the channel yet, well, you can do that right over here. This is Nick signing off. Thank you very much for watching, and I'll see you again soon.